Hey, what's going on, guys? Welcome back to another SCAG Academy video lesson. And in today's video, we will be discussing inefficient price action. So let's jump right in. As you guys know, the market is a constant battle between buyers and sellers, but every now and then one side of the market can take complete control over price. And this usually leaves us with what we call inefficient price action. This does also go by other names such as imbalance and fair value gap. It really just depends on who you're listening to and who wants to explain it in a certain way. I do call it inefficient price action. So first off, inefficient price action is often very easy to spot. It's identifiable as a candle that has a portion of its body that has no additional price action testing the same area as it is formed. And below is such an example. So if we take a look, you can see that inefficient price action that we have labeled where price is very much being overtaken by sellers. Sellers are moving the market in one smooth direction. There are no wicks or additional candles that test inside of this area. It's all purely sell action, a lot of momentum in that market. All right, there's no price retests in that area. Whereas if you kind of take a look at the efficient price action that happens right below it, you can see with every candle, there's some movement back to the upside. It's filling out some of that recent action. So big difference between efficient and inefficient, usually very easy to spot on the charts. Now let's talk about why this is important. All right, so inefficient price action, this lets us know that due to the market's nature of balancing out supply and demand, that price is likely to come back and fill out some of that missing supply or demand, right? Some of that inefficient price action inside of that inefficient price range. Now, however, I don't want you guys to get used to the idea that meaning this has to immediately come back to these zones. That does not, it's not always what's going to happen. We're going to talk about this in a little bit, but oftentimes price will continue to make more market inefficiencies until a new cause, which we know is an accumulation or a distribution, is formed that will again cause the effect or the markdown or markup to go and close the inefficiency. So once we have a valid cause to come and close the inefficiency, we can then use this zone as an area to begin scaling out of our positions from that new cause, unless there are other inefficiencies that remain open to target. So what do we actually mean here, right? Let's take a quick example. This is a chart where there is an inefficiency created. We can see that the buyers are very much in control here. Nice massive momentum push to the upside. We start getting some, a bearish candle. We look to continue. And we just let the market play out some more. Again, it creates some more efficient price action, but eventually hits another area where demand starts to overtake, and we start to create additional inefficiencies inside of that market. And then we have a cause that's created, right? So we actually enter a trading range on a little bit of a lower time frame, but still pretty visible on this one. And we get that new distribution that forms. This builds up a new cause, and then from that cause, we begin to go out and close some of these inefficiencies. So you can see it closed out those more recent inefficiencies that we have on this current candle, but since we still have inefficiencies created lower, we do expect price to again continue a little bit lower. So we can see as the market played out, it created more redistribution cycles, more causes to bring the market down and fill out those old inefficiencies. Now, there were some new inefficiencies created on this move, but we don't expect price to go back there yet because there isn't a current cause on the market. There's no clear accumulation or a reason for us to go up and fill that. And then from here, we would expect the cycle to basically continue with the same pattern, right? Does an accumulation form come back and take that new inefficiency, or does it continue redistributing and creating additional new inefficiencies? So that brings us through the inefficiency lesson. Pretty easy stuff, pretty easy to identify. Will be a little bit trickier to practice in the actual market, but if there's any questions, comments, concerns, throw them below this lesson or in the Discord and community, and I will be happy to answer those for you. So as always, I will see you guys in the next lesson.